we're up to S. We're getting through the alphabet, Jade.
We are. We'll be back at A soon.
Oh, I think we'll have to do something different. I don't think we can go through it again.
We'll come up with something, I'm sure.
We will. So this week, S, I was thinking about it. I mean, we had quite a lot of options for S, but I was thinking about what I get asked most about. And one of the questions I probably get asked most about is SMSFs, which is a self-managed super fund. And so we thought we might use this as a bit of an opportunity for Jade to be the client.
Your brain, Jo. I will pick your brain.
And ask me some questions about it, as I probably tell clients all the time.
All right. So first question, what is a self-managed super fund?
Okay. So a self-managed super fund, we all have super. Most of us have super. Very few people wouldn't have super, particularly unless they're under 18 or have retired and used all their super. But so a superannuation fund is where you put your superannuation contributions and save for your retirement. Now we have the option of using retail funds, industry funds, and the option of self-managed super funds. And a self-managed super fund means it is a fund that you manage yourself.
And
that makes sense, doesn't it?
It does, yes. So why would you choose, or why would someone choose to put their money into a self-managed super fund over an industry super fund?
Okay, so the whole point of the self-managed super fund is that it is something that you can manage yourself, and a lot of people feel that they can do better than the industry fund or the retail fund. There's a number of reasons people go into them. So first of all, I would say that if you've had one for a while, it may have just been that your accountant told you should do it, because back a few years back, and I'm probably talking at least 10 plus years back, often if someone had come in and they're a business owner and you go, oh, well, we'll set you up a self-managed super fund, and, a lot of accountants actually kind of like doing that, so they got extra fees out of the client. There is potentially that little bit extra control there. But most of the reason people go into it now is because they potentially have a bit of an interest in the markets. They think they can do a little bit better, or more than likely they have a interest in investing in property, which we can do. And I think we'll talk about that a little bit later, because I think there's a few things to get to before we get to the property side of it. But obviously, if you're in a retail fund, you don't have any choice over, or an industry fund, you really don't have much choice over what you can invest in. There is a little bit of choice there potentially, but you certainly can't go and say, well, I want to invest in a property, whereas with a self-managed super fund, you could.
Yeah. So obviously with a self-managed super fund, I assume that there would be fees involved in running that. And is there regular compliance activities that need to be taken as well?
Most definitely. So there's fees and there's a lot of compliance. And this is why I think whenever someone comes and asks me about a self-managed super fund, first of all, I can't tell them whether to go into it or not, because I am not a financial planner. So all I can give is general information about how they work. First of all, which is what I'm going to talk about today. Once I've done that, that gives them the option to then think about whether they want to go into a self-managed super fund. And if they do, I would then ask them to go and see a financial planner to get a statement of advice to see if that's the best thing for their situation. So what I'm talking about today is just the general information around a self-managed super fund, not telling anyone to go into it. So the first thing is cost. Yes, there is cost involved in it, of course. So the cost is going to be that every year we have to do a set of accounts for you. Every year we have to get them audited. Probably around the minimum cost would be about $2,000 in my mind for a self-managed super fund, and that's assuming everything's pretty clean.
So it can go up from there.
Certainly
if it gets a bit more complicated.
Yeah, I mean, we have some that we, have thousands of dollars of fees on there because they're complicated or they're messy. So there's also a fee that you do pay to the government for it, which is part of the tax return. So in your tax return there is a fee. I can't tell you what the amount is at the moment, but it's probably around $300 or $400 a year. To be honest, I don't do the compliance. That's outsourced. Well, not outsourced. It's done by Justine from our team. When I say outsourced, it's outsourced from me.
You don't do it.
Yeah. So, but I mean, I do obviously know how they work and everything like that. But so there is a fee that you pay to the government, and then obviously a fee you pay to the accountant. As part of that, it has to be audited there's a fee you pay to the auditor for that. For our clients, we arrange the audit. It's all included in the one fee, but it's definitely has to be audited by someone independent from us. We can't audit super funds, and we certainly wouldn't be able to audit ours, but we're not auditors of super funds anyway, so we can't do anyone's audit. Compliance-wise, you have to do everything by the rules, and everyone gets something wrong.
And so what are some of the common rules that you think people should know, or the rules that you see broken most frequently?
Okay, so the first thing is it is for your retirement. So it's really important. I mean, suddenly you've got a bank account that you have access to that could have hundreds of thousands of dollars in it. I mean, we've all got different amounts of super. That money is for your retirement. You can't do anything with that until you reach retirement age or, some sort of release thing. And even then you've got to go through a process to get that money. You can't just go and pull it out. So the main rule is that you can't use that for anything other than the purposes of retirement.
So very similar to an industry or retail super fund in that sense too.
Exactly. So it depends on what you want to buy with it. So there's things like you don't want to, like you can't go out and buy a house and put your child into it. So because then there's a mixture of the purpose that you've got there, or you can't live in that house. It has to be purely a rental property that is not in any way associated with you. There is one exception to that, and that is if it's a commercial property and your business is coming out of it, you do have that as an exception. You can run your business out of commercial property, but of course that has to be very specifically you can't make that up and say, it's my, I've got a home office in there or something like that. It's a full proper business thing. So you can't buy assets off yourself unless they're listed securities. So again, another thing to be very mindful of. And then there's lots of little compliance things like, you have to have policies and bank accounts and everything in the right name. Like if you can't have an insurance policy for your house and put your name on it, it has to be in the super fund's name sort of thing. If you've bought an investment property in the super fund, there's just lots of little bits and pieces. It can be very messy.
Yeah.
As a trustee of a super fund, so again, let's just go back to that. So a super fund can have a maximum of 6 members in it in a self-managed super fund. The trustees of the super fund, so it is a bit of a complicated situation how they're set up. The trustees must be members, the directors of the trustee company must be members of the fund, and vice versa. So there's a few little issues with that. You have to make sure you got everything correct there. So it's quite complicated.
Yeah.
But those trustees do have to, when they become a trustee, you have to sign a declaration with all the rules that the ATO tell trustees to declare that they understand what they are. So you can't then come back and go, well, I didn't know, because you've already signed this declaration.
Yeah.
Even if you haven't read it.
Yes, and the ATO are quite strict on it as well, aren't they? Anything to do with super.
Incredibly strict. And if you're like, so what happens is you set up a super fund, it's automatically considered complying, which means that the super fund is able to get the complying tax deduction, or the tax rate, which is the 15% tax rate for super funds. If it turns into non-complying, then it will potentially mean that anything's taxed at the highest marginal tax rate, or it can be sort of in this temporary mode of being not complying but not non-complying as well, which usually happens when it's late in getting lodgements. And what will happen then is if you're trying to put money into that super fund, you won't be able to do it because it's no longer a complying super fund.
Yeah, so it can get a bit messy.
Yeah, so you've got to be someone who's really, first of all, good at keeping records. So you need to keep every piece of paper that has anything to do with the super fund. You can't just throw it in a drawer and forget about it or throw it in the bin. And you have to be on top of it and make sure that you get your stuff done in a timely basis.
So, Jo, you briefly touched on it earlier about buying a property in a self-managed super fund. I imagine that's something that a lot of people would like to do.
Yeah.
So is that possible, and how do they go about that? What's the situation with buying a property?
Yeah, okay. So if you've got enough money in your super fund to buy a property, yes, you can buy a property. There's nothing wrong with that. But what happened is a few years back, and it's been quite a while now, they actually brought in what's called a limited recourse borrowing arrangement, which is a way that you can actually borrow money from a financial institution to, or even from another person in your own group, to be honest, but that's pretty rare. Like, you have to have a fair bit of money to be able to do that. But you can borrow money through the self-managed super fund to buy a property. So now this is what a lot of people are quite interested in, and often people will come to me and say, I'm interested in buying a property, or I found a property, can I set up a self-managed super fund and buy it in there? If you've already found the property and you've set up and you've put a deposit on it, it's too late.
No.
Sorry, because everything has to be done in the proper order. So the first thing that they need to understand is buying a property with a limited recourse borrowing arrangement is going to be expensive because they're a niche kind of loan. Most of the banks don't do it anymore. They're usually only done through different tier lenders such as Liberty Finance and potentially Latitude. There's a few that will do it, but you can't go down to the Commonwealth Bank or National Australia Bank. They won't give you a limited recourse borrowing arrangement loan anymore. Because of the fact that they're a bit niche, the interest rate's going to be more than you would pay if it was just a normal investment loan. But what we have to do is set up another trust, which is called a bear trust, to be able to buy the property. So this is going to then cost you extra money. So first of all, you would set up the super fund, which is going to have a trustee, which is going to be a company, plus the trust, which is the super fund. You're probably looking at around $2,000+ for that setup. Then to buy the property, you're going to have to do that all again with a different company and a different trust, which is called a bear trust. There's a lot of complication around making sure you get the name right on the contracts and everything like that. So it is a little bit of a complicated situation. It definitely works. Like, I'm not suggesting you don't do it, but you just need to be mindful that your rates aren't going to be like, you're not going to be able to shop around and get a great rate for it. It'll be what it is. And yeah, you will essentially pay that loan through the super fund, get the rent in, and then eventually hopefully own that property, in which case the title will change from the bear trustee back to the super fund.
Yeah. So along with property, people can, own shares in super funds as well, I'm assuming. We see people that hold gold and artwork as well.
Yeah. Look, again, if you're looking to buy artwork or collectibles, you've got to be very careful with that. Essentially, you're not allowed to get any benefit out of that while you're not retired. So, or even while you are retired, if it's still in the super fund. So you can't put the artwork on your wall, right?
Up in the house.
You can't drive your collectible old car. And so you also have to have those valued. So one of the things with the super fund is you have to have everything valued every year. And property is relatively easy to value. We've got, ways to do it. But how do you value an artwork? How do you value a collectible car? You're going to have to get a proper valuation. It's going to be expensive. Some people do buy bullion and they have to be mindful of where that's stored. You would probably want to get a safety deposit box somewhere to put it, so you don't really want to have it at home because you're starting to breach issues there. Like, I don't know, do people like to look at their gold? I don't really know.
I'd probably look at it if I went to gold bullion.
Yeah. So there are some complications with that, although that is a possibility. And again, then it starts to, is it an issue with gold is it just a bullion or is it a coin, in which case it might start to become considered a collectible. So I'd really honestly say, if I was, not that I can advise anyone, I'd be very careful with buying anything apart from sort of the standard stuff.
Yeah, and so do you mean like shares and things like that?
Yeah, exactly, shares and property. I mean, that, of course, the property tends to be the thing that people are most likely to do. Just be aware, if you are buying property, though, you will have to have a certain, like the financial institution is not going to lend you 90% of the property. They're going to lend you up to what they call, there's like an LVR, so a loan to valuation ratio. Probably at the best you'd be getting like maybe 70% of the loan, of the value. So you're going to have a reasonable deposit. We also have to be mindful about the liquidity of the fund. So are you going to, even if you use every single cent that you have in there, are you going to be able to pay anything that needs to happen? Like, you've got to be careful with all of this. So there's a lot of thought that has to go into it and planning, and that's why a financial planner needs to be involved. You are also able to get life insurance in your self-managed super fund, and this is another reason I believe that financial planners are involved, because a lot of people have set up a self-managed super fund, rolled their benefit over from their current fund, which did have life insurance in it, into a self-managed super fund. They no longer have life insurance. Something happens, and who's responsible for them not having that life insurance anymore? So there's a little bit of planning that needs to go into all of that as well.
Yeah, definitely. And those insurances are something that people do easily forget as well.
Yeah. So typically we would not recommend I can't recommend anyway, but most people would not recommend a self-managed super fund unless you have at least $200,000 of funds in there, because it's not economically viable. The cost versus of running that fund is just not, you'd be better just having it in a retail fund, in all honesty, or an industry fund. Yeah. All
right. Are there any other questions that you commonly get asked that I haven't asked?
I think it's fine to talk to people, to ask your accountant about a self-managed fund, and they probably would be able to suggest whether it's worth looking into or not. There is the ability to go online and buy your own fund. I would not recommend that. If you do, I'm not taking away from the people who do that, but you really need to know what you're talking about. It's complicated stuff. And the other thing is, people think that they can look after their fund themselves by using like MYOB or Xero. Don't even try and do that. It is a much more complicated way of accounting. We have to keep member balances. So, if Jade and I, for example, went into a fund together, I would bring my certain balance in, Jade would bring her balance in. While our funds are pooled together and invested together, I still have my balance and Jade still has her balance, and it's sort of adjusted based on what contributions are going in and what income we're earning from those investments proportionally. So it's a pretty complicated way of accounting. And then if someone goes into pension mode and it's complicated stuff. So definitely don't ever try and do it yourself. I have seen people who think they can, and honestly, it makes it more difficult for us when we go to do their accounts.
Yeah,
when
it's
they've done it themselves.
One of those things that it's definitely worth paying an accountant to just get it done properly from the beginning.
Yeah. So look, if you're thinking of it, think about why you would want it. And one other thing I would be very mindful about as well is, how much time do you want to spend doing this? You might be fine now while you're, in your 40s, 30s, 50s, whatever. But once you start to get older, are you really going to be wanting to do this? Are you going to be in a position where you can manage it yourself? We are seeing a few of our older clients now where we're actually finding that it's just too much for them, and they have to roll their money out because they can't manage it anymore. There's lots of things that go in it. It's a really complicated area. So.
Yeah, definitely. And I mean, even just the record keeping, and I mean, it's something that we see in the office all the time, because as you said, you do need to prepare, an annual financial account for the super fund, basically its own tax return. And you do need every single piece of paper.
Yeah, and if you haven't got everything right, there's two different types of so the auditor can qualify your accounts. There's two different kinds. There's a Part A and a Part B.
And qualifying's not good. It sounds good, but if you go
qualified,
it's qualified. It's kind of the opposite. You don't want to be qualified.
It means that you've done something wrong. So one of those will just be a letter telling you you've done something wrong. Another one will be actually a report to the ATO to tell that you've done something wrong. As part of that report, they will tell the ATO if you've fixed it or not. And if you haven't, then the ATO can come and audit it themselves, or actually request that you wind up the fund, or they can, there's all sorts of penalties that could potentially apply if you aren't doing it correctly. Now, we find that nearly everyone has something in their audit letter that hasn't been done correctly, and it could be that the investment that you've made is in an unlisted entity and that entity hasn't been audited itself, so they can't verify that. Or it could be something as simple as you opened your bank account, the very first thing you did was open the bank account and didn't roll any or put any money in it, and the first thing that happened was a bank fee, and suddenly your account's in negative, which you can't borrow money as a self-managed super fund unless it's through that limited recourse borrowing arrangement, and you've already breached.
Yeah.
So it might be a $2.50 fee that's caused you to breach. So that's what I mean, it's pretty full on. There's a lot of work involved in it.
Definitely. So, but if somebody is interested in the process of setting one up, you would recommend that they start with their accountant and then a financial advisor?
No, I'd actually probably recommend, first of all, if you feel like you want to talk about it with your accountant, know that they can't tell you whether you can do it or not. All they can do is maybe look at your situation and ask you how much super you've got. Like, I mean, this is what I do if someone comes and asks me. First of all, I'm very straight. I can't tell you whether to do it or not. How much super have you got? If they got like $30,000 worth of super, I'm going to go, well, you're not going to, there's no point going any further. Like, it's really not worth your while. Yes, no financial advisor is going to give you permission to do it. No bank is going to lend you money to buy a property with that sort of balance. So I wouldn't go any further. I probably just give them a bit of a rundown about how much it's going to cost them, because I think it's important for them to know if they're going to make that decision that they're going to be up for probably $4,000 or $5,000 before they do anything.
And then the ongoing
yearly ongoing costs, just to give them a bit of an explanation, because they might be thinking, oh, I want to buy a new car and I've been told I can buy a car in myself. You know, so some of the questions you get are kind of out there. What are they thinking? Just so that I can tell them whether it's even possible or not. And then after that, they need to go and see a financial planner. I won't be setting up a self-managed super fund unless they've got that statement of advice.
We can't.
Yeah. So while I'm not advising them to do it or not, I'm just realistically looking at the logistics of whether it's even a possibility to do what they're wanting to do, and then they need to see a financial planner from there.
Perfect. Lots of information. Any other questions or things that you think people need to know?
There's probably a million of them, to be honest, but I think
we've covered the basics.
I think we've probably covered the basics. I think that's probably a good starting point if you are thinking about it. Have a bit of a chat. Just be careful. Like, a lot of people, I have people come to me and say, oh, someone told me I should be buying an investment property in my self-managed super fund, which I don't have yet.
At the pub, they hear that.
And I'm like, just remember, your circumstances are different to other people's circumstances. Like, everyone's different, and just because someone says that that's what you should be doing doesn't mean it is what you should be doing. You know, you are unique and your situation will be different to everyone else's. So just be mindful of that, I think.
Definitely.